Good evening, everyone. My name is Alexander Bisowa, and you are welcome to the continuation of our seminar, Are You Prepared? The very goal of it is to actually continue with the stock market section, where we want to have a conversation with William Mensah. William Mensah happens to be a wonderful lecturer and also a professional in the investment business, having done this for over 17 years over the period. I can attest to his depth of knowledge and wisdom and insight when it comes to financial planning and helping people enhance their finances. As a matter of fact, we expect this to take about an hour. We've already eaten 10 minutes of the time, I think so. And we want to apologize, another hitch up, I should think. Over the period, would probably discuss what the stock market holds as a potential, and then also delve into other aspects, probably around retirement planning and also investments, which is also a wide array of planning where William also can actually teach us much about. From this point on, I would like to introduce William Mensah onto the stage. William, you can share your screen now.
Okay, thank you. I was mute.
Okay.
Okay.
Start with a brief about yourself and then, yeah.
Okay, good evening, ladies and gentlemen. My name is William. I've been in the investment banking industry doing various things, from stock brokerage to raising capital to financial planning to advisory to private equity since 2003. I also like teaching. So my real passion is teaching. So I've been lecturing at the Ghana Stock Exchange, I think since 2005. I would want us to finish in time to be able to have time for questions. So hopefully the presentation should not be too long. So we'll look at how the stock market works, and then we'll look at retirement planning. And then if we have time, I'll share a few thoughts on investing in general. Okay, so how the stock market works. I'm sure majority of you, when you are watching TV and it's time for business news, or you are listening to radio and business news and they start talking about the stock market and they are using terms like on the market today, there were 3 advancing equities and there were 2 laggards. You just change your channel and say, what is this that they are talking about? So today we want to break it down to the layman's terms so that we all understand what the stock market is. Okay. Good. So we'll look at a history of stock exchanges. How did the whole idea of stock exchanges come about? Stock exchanges in primitive form, not in the form that we know, has existed for a very long time. As early as the 1300s, there were money lenders in Europe who lend money to people, and when they need money, they require someone to buy that debt instrument off their hands. So let's say I lend money to Alex, and Alex is supposed to pay me back in 6 months. But 3 months down the line, I need that money. How do I get that money? I need to be able to sell that debt instrument to someone else so that someone will collect the money from Alex in 3 months' time whilst he gives me money today. So these money lenders, they used to display the loans that they have on boards. and in marketplaces and things like that, so that other people who are interested will now come and buy off the debt from them to be able to get money up front. So that is the most primitive form of a stock exchange as you can think about, because the whole idea of a stock exchange is to be able to trade financial instruments. And so these guys were trading loans that they have issued to individuals amongst themselves. So it was some kind of an exchange that they had created. But the first organized exchange, the very first one, was in Antwerp, Belgium in 1531. But that exchange also was trading only debt instruments, only bonds that companies have issued. Companies borrow money and they issue bonds and use that bond to borrow money from the public. And the Antwerp exchange was available so that individuals who wanted to buy those instruments could go ahead and buy it, and then the issuers could sell the bonds ahead, the instruments ahead of time to realize some money. So that was the first organized exchange. So at that time, there was no idea about limited liability company that was issuing shares or selling ownership to the general public. Okay, when we talk about shares, it's about ownership in a business that has been divided among a certain number of individuals. So the first idea of a limited liability company existed in the 1600s, where the British, Dutch, and French governments issued charters for the voyages that were going to Asia. So these were there were ships that were sending goods to Asia to go and trade it, and then they would take raw materials back from Asia into Europe. So these were ships that were moving across the oceans, mainly to Asia. Now, people wanted to invest in these voyages. And they were expensive. The voyages were expensive. To have a ship cross the ocean to Asia and take goods to Asia and bring raw materials back into Europe was quite expensive, and it was risky because ships were sinking on high seas and the rest. So they had this idea that individuals should be able to invest in these voyages. Okay, so they created these charters that allowed individuals to invest in the voyages. And this was the first idea of a limited liability company, because what was happening is that if the voyage was successful, then the investors will share in the profit of the voyage. However, if the ship sank, the maximum they will lose is how much money they committed to that voyage. Okay, so they were not limited liability companies like we know now, because the charters was on a trip-by-trip basis. So each trip to Asia represented like a company that is set up and will be dissolved when the ship comes back. So it was on a ship-by-ship basis. And they issued certificates to cover these investments that the people have made. And so there was a meeting of sorts in coffee houses where people would trade these certificates. So that was the first concept of trading in shares or ownership that existed as we knew it. But the modern stock exchange started, the first of it was the London Stock Exchange in 1773, and then the Philadelphia Exchange in 1790, and the New York Stock Exchange in 1792. So you're talking markets that are more than 200 years old, 250 thereabout years old. Okay, so now let's look at the history of Ghana's stock exchange. The first ever treasury bill, government issuing an instrument for people to be able to buy, happened in Ghana in 1954. I'm going to give the slides out to everybody. I have put some links to some websites on some of the slides, because there's a lot more information of interest there. So you, in your own good time, you can go and read more on some of these subjects. Now, so the first treasury instrument was issued in 1954. And Bedema was the finance minister at the time when Nkrumah, this is before independence, Nkrumah was prime minister and Bedema was minister of finance. And Bedema, at that time, we had excess money. It wasn't a situation where government needed money to finance its budget like we have now. We had excess cash. So the only purpose for that instrument to be issued was to create a market for securities. So way back in 1954, there was this idea that we should be able to create an instrument that people can trade in. So this is before independence. And then in 1960, the Accra Securities Market Limited was established. So following that issuance of the first instrument in 1960, an Accra Securities Market Limited was established with the idea of creating an exchange. However, it never came into fruition and the government was overthrown. And then after the overthrow in 1971, the Busia government passed the Stock Exchange Act to enable or to create a legal framework for a stock exchange to exist in Ghana. At this time, there were only 6 stock exchanges in Ghana. Unfortunately, not long after, in 1972, the Busia government was also overthrown by the Achampong government. And when the Achampong government overthrew the Busia government, it did not go ahead with the original plan, but rather what it did was that it created the National Trust Holding Company, NTAC, which still exists. They have their old offices in Dabraka and they have a new office at the airport now. So NTAC was created, and after NTAC was created, government converted 18 state-owned companies or foreign-owned companies, 18 companies that were owned by foreigners. They converted them into public companies so that they can trade the shares over the counter. So these include companies like Stanchart, today Total, but they used to be called Texaco, and a number of companies. Okay, so these were all foreign-owned companies that were converted into public companies, and shares were traded over the counter. Over the counter means that there is not an organized stock exchange with stockbrokers where you can go to them and say, I want to sell or I want to buy, and then they'll go on the floor of an exchange and go and do the trade. However, individuals who wanted to buy and sell shares could agree between themselves, and TAC would effect the change of ownership from the person selling to the person buying. So that was what Achampong decided to do. And then in 1989, a committee headed by the governor of the Bank of Ghana was set up to establish the Ghana Stock Exchange. And then in 1990, November 12, 1990, the whole idea about setting up a stock exchange finally became operationalized. And there were 11 listed companies and 1 bond. 1 bond was also listed. And there were 3 stockbrokers at the time: Data Bank, EcoBank, and I think NTAC. They were the 3 stockbrokers that started. Okay. The structure of the stock exchange. So let's compare what existed in 1990 to what it is today. What has the journey been? So remember that when we look at the history of the stock markets, we had markets that have been in existence for nearly 250 years, and our market has been in existence for 30 years. So we have to be mindful about our criticism of our markets, because only 30 years old. The developed markets, they have developed what they have been doing over 2 centuries. Okay, so in 1990, there was just 1 main market with 11 equities and the bond. But today, as we speak, there is the main market where all the big companies are listed, Standard, EcoBank, Fan Milk, and the rest. And then we also have the GAX, the Ghana Alternative Exchange. That is an exchange that was created for small companies to be able to list. So we have small companies like Intravenous Infusion, HOTS is the company that does brown gold, bitter cocoa. So the GAX was created for small companies, previously privately owned startup companies and all those little companies to be able to list. Unfortunately, it did not get a lot of traction, and so far we have only about 5 companies listed. And that exchange, that market is not doing too well. And then we also have the Ghana Fixed Income Market, which is a separate market for the trading of bonds. So there are so many bonds. There are government bonds, and so the next point will come to listed securities. In 1990, we had 11 equities and 1 bond. Now, today, we have 31 equities on the main market. And then we have 2 derivatives. Okay, so the derivatives, okay, if I explain what they are, you would understand. So for instance, the first one, the AADS, is the Anglo Gold Ashanti Depository Shares or Depository Receipts. Now, we all know Anglo Gold Ashanti. When Ashanti Gold merged into Anglo Gold, the new company that was created was listed on the London Stock Exchange, and was also listed on the Johannesburg Stock Exchange, and was listed on the Ghana Stock Exchange. The price per share on the exchanges were such that a number of small investors in Ghana did not have enough to even own 1 share. So basically, you had Ashanti Gold, you had Ashanti shares. Ashanti has now been combined with a South African company called Anglo Gold. So you have new shares in this company called Anglo Gold Ashanti. So assume that, let's say you had 50 shares in Ashanti Gold. Now that 50 shares, when you translate it into the new company that has been created, Anglo Gold, you cannot even own 1 share. So what they did was to create this depository receipts, which was like a fraction of a share. So 100 depository receipts made 1 Anglo Gold share. So that if your shares could not qualify for 1 Anglo Gold share, then you would get to trade in the depository receipts. So that's the AADS. Now we call it a derivative because the value of this depository receipts is derived from the value of the main share, which is the Anglo Gold shares. Okay. If you ask brokers on the market whether they have the derivatives on the market, they will tell you no, because by the time we listed this Anglo Gold Ashanti Depository Receipts, even the market itself did not understand that what they were creating was basically a derivative. And then in 2010, thereabout, we had the gold ETF. Now, ETF stands for Exchange Traded Fund. The idea behind this, how this is structured this way: you have real gold. You have a company that has bought real gold and has put the gold in a depository somewhere. I think it's Deutsche Bank. So they have the gold sitting in a safe house somewhere. Now, based on the value of that gold, they have created this financial instrument so that each financial instrument represents a small fraction of an ounce of gold. And then now they sold this paper on the market and listed it on the stock exchange. So that if you want to invest in gold, you don't have to go and buy real gold, because if you go and buy real gold, you are faced with a lot of challenges. First, how do you ascertain that the quality of the gold is what it is claimed to be? You have to be technical enough to know. Secondly, where are you going to keep the gold? You must have a safe place to keep the gold. And thirdly, if you want to sell your gold, you must find someone who wants to buy the gold, etc. But with this derivative, what it means is that the the real gold is sitting somewhere and you have bought a paper that represents a certain fraction of the gold. So when gold prices go up, you get to benefit from the increase in gold price. When gold prices fall, you also suffer the loss of that. Okay, so those are the two derivatives. And then we have a preference share. A preference share is different from the other 31 shares that we have on the market in the sense that this one comes with a fixed dividend. If you buy shares, you are not promised a dividend. If the company makes money, they may decide to pay dividends or not. Okay, so it comes with fixed dividend. And then we have 5 shares listed on the GAX, as I mentioned before. We have 91 government bonds listed on the fixed income market. We have 81 corporate and statutory agency bonds. Statutory agency bonds, this includes the energy sector bond. Remember when we had the issues with the bulk oil distributors, a certain bond was issued to be able to cover government's exposure to the oil industry. Those bonds are listed. And then, so we have the ESLA bonds, and then we have some other statutory agency bond. So the 81 corporate and statutory agency bonds have been issued by 10 different issuers, including Eastway, Bayport, PBC, and a few others. Okay, market capitalization. Market capitalization simply means the value of all the shares listed on the market. So if you take each company and you take the total number of shares they have and you multiply it by the share price, that will become the market capitalization of that company. Now, if you take the market capitalization of each of the companies and you add it together, then you get what we call the total market capitalization. In 1990, the value of all the shares of the 11 companies that were listed was 3 million Ghana cedis, less than $1 million. Today, it is 53.1 billion Ghana cedis. Now, if you take out the foreign companies, the Anglo Golds and the Talos and the rest, and you look at only the local companies, then the value of all the local companies listed is 19.3 billion Ghana cedis. Trading system. In 1990, we started with a manual system where people meet on the stock exchange and then they physically trade. They say who wants to buy this, and people are bidding at different prices for various things that they want to trade. But now we have an automated continuous auction system. You don't have to go to a physical place. You can sit in your room, you can sit in your office, and then you can trade. As we speak now, some of the brokers have systems that they can give you, the client, access to go and put your order in yourself and buy and sell your shares. Okay, so as we speak now, you, the individual, you can sit in the comfort of your bedroom and be placing orders to buy shares. Okay. Trade value, total value of all trades on the market. On the stock exchange for the shares, the total value of all trades on the market has been 4.6 billion cedis for shares, and then 85 billion cedis for fixed income. A link to a website here that you can get a lot more information on these things that we've talked about. Okay. Good. Now, so how does the stock market work? The stock market is divided into 2 main segments, the primary market and the secondary market. Now, the primary market is the market for brand new securities, brand new instruments that have been issued. So the main distinguishing feature between a primary market and a secondary market is that on the primary market, the money that is raised goes to the company that is issuing it. The secondary market, on the other hand, is trading between someone who has already bought the shares or the bond and someone else who wants to buy it. So the money moves from the person who is buying to the person who is selling. Whereas on the primary market, the person who is selling is the company itself, not someone who has bought previously. And so the money goes to the company. So the primary market, I mean, all of you remember MTN's share offer. Okay, what they call the IPO. IPO stands for Initial Public Offering of Shares. So what happens is that, first of all, you have to take the decision to issue shares to the general public. In the case of MTN, that decision was forced upon them. There was an auction of the 4G license, 4G internet license. And in one of the conditions of the auction was that whoever wins the auction, after a certain number of years, you have to sell a minimum of, I think, 30% of your shares to the Ghanaian public. So MTN won the auction. And so based on that deal, they were under an obligation to sell 30% of their shares to the general public. So they offered 30%, but the Ghanaian public was not in a position to take all those shares because the value of the shares were just too much. But most of the time, companies do IPOs because they want to raise new capital. They want to raise funds for an expansion, or they want to raise funds to pay off debt, or they want to raise funds so that some existing shareholders can exit. Okay, so usually that is the idea behind the IPO, the initial public offering of shares. But besides the IPO, we have what we call the rights issue. The rights issue, these are also primary market instruments, but they are issued by companies that are already listed. So you're already listed and you need extra capital. What you will do is that you issue additional shares to your existing shareholders for them to put new money in the business. If you do that, we call it a rights issue. And then we also have what we call the seasoned offer, which is similar to the rights issue, except that in the seasoned offer, you are not offering the shares to your existing shareholders, but you're offering the shares to the general public. Before you can do a seasoned offer, your existing shareholders must give you the right to do that. They have the first right to buy any shares that they are issuing. So they must let go of that right before you can do a seasoned offer. The process of issuing shares to the general public involves you putting together a certain information memorandum that we call prospectus, which includes all the information that is necessary for the investor to be able to take a decision on whether to buy that shares or not. Now, when you do this prospectus, you have to send it to the Securities and Exchange Commission for them to vet the prospectus. It is not everyone who comes out and say, I want to raise money for the general public, that is allowed to raise money from the general public. Aviance, the cargo handling company at the airport, in 2007 or 2008, I think it's 2007, wanted to issue shares to the general public. However, the Securities and Exchange Commission did not allow them to issue the shares for the simple reason that their contract, the contract by which they operate at the airport, is only a 7-year contract. Now, so the Securities and Exchange Commission's idea was that, okay, you come and sell shares to the general public with the idea that you are going to exist here forever. What happens if your license expires and the government decides not to renew your license? Then what happens to the shareholders? So they did not allow them to issue the shares. There was another company called Bluemont. Bluemont was a company that was into the share nut and share butter business. And they wanted to raise money on the stock market. Their parent company was a UK company. They refused to disclose information about who their parent company was. I think there was going to be some tax implications on them if they disclosed full details about their parent company. In that particular instance, the share offer started. So the IPO was launched. People have started buying the shares. And then CTFM, City Business News at the time, got information that there was something shady about the parent company, and they started investigating and making a lot of noise on their business news. And so the Securities and Exchange Commission asked them, suspended the offer, and asked them to bring more disclosure about the parent company, which they refused to do. And so the offer was canceled. So it is not anybody who wants to go out there to raise money that is successful. A lot of times we hear that people are raising money on the stock exchange. I understand why people say that, but technically, you are not raising money on the stock exchange. You are raising money from the general public with the help of the stock exchange. The help that the stock exchange gives is that when the offer is successful, after you raise the money, you will go and list the shares on the stock exchange so that people can trade the shares, and that makes it attractive. However, you don't need to list the shares on the market for it to be successful. Fidelity Bank did a public share offer where they raised money from the general public, but in the prospectus, they said that they were not going to list the shares, and yet the offer was successful. Accra House of Folk said that they were issuing shares to the general public, they were going to list it on the Ghana Stock Exchange, and yet it was not successful. So the fact that you want to list it is not what will make it successful. What will make the offer successful is whether it is attractive or not. Now, so after the primary market has done its work and the company has issued the shares and gotten the money they want, then the stock gets listed on the Ghana Stock Exchange, and that brings about the second market, which is called the secondary market, which allows individuals and companies who previously bought the shares to be able to trade amongst themselves. Now, those of you who have shares on the Ghana Stock Exchange, you will know that our market is pretty much illiquid for some of the stocks. What I mean is that there are certain stocks that if you hold and you want to sell, you find it very difficult to sell. And there are also certain stocks that if you are looking for the shares to buy, you find it very difficult to find some of the shares to buy. Now, the major reason accounting for that is because our market is structured such that you don't have independently licensed market makers. Now, the role of the market maker is like, so if you think about the stock market and you relate it to the market for all other goods on the market, like toilet roll or toothpaste or whatever it is, the market maker is like the wholesaler. Okay, the market maker is like the wholesaler and the broker is like the retailer. Now, so if the broker is like the retailer, and there is no wholesaler on our market. So on our market, we don't have independently licensed market makers. So if you only have retailers and you don't have a wholesaler, then if the retailer wants to buy something, who does it go to? The retailer is now only going to individuals who have it to be able to find the shares. However, if you have market makers which are institutions that have been licensed purposely to buy shares. So the market makers, how it is structured is that if you are licensed as a market maker for, let's say, CalBank, at any point in time on the market, you must have a price at which you want to buy CalBank and a price at which you want to sell CalBank. At any point in time, you must have those two prices on the market. The price at which you want to buy CalBank and the price at which you want to sell CalBank. Now, so what it means is that if the broker wants to sell CalBank, he is guaranteed that someone will buy it. The only problem will be maybe the price that he wants to buy will not be price that you want to sell at. But as long as you want to sell, if you are desperate enough, there's someone there who wants to buy from you. And then also there's a price at which he's selling. So as long as you want shares to buy, there's someone who is in the market to sell you the shares. You may not like his price, but he's there. We don't have independently licensed market maker. Rather, the license that the stockbrokers have, the stockbrokers in Ghana, they are called licensed dealing members. So their license allows them to be both the market maker and the broker. So they are licensed to be both the wholesaler and the retailer, and that structure is not working well. So the Securities and Exchange Commission now is putting in regulations to license independent market makers. When that happens, liquidity on the market will improve. So we don't have the market makers, but we have the retail investors who are the individuals who trade in shares. The problem with individual retail investors is that majority of the retail investors are not informed. They follow what other people are doing or what people are saying. So when they see that a certain share's price is going up, they don't ask why it is going up. All they know is that farm milk has gone up 50%. Hey, I want to buy some. Or farm milk has fallen 50%. Hey, I want to sell my shares. They don't ask why it has gone up, why it has fallen. All they will know is that they want to trade some because someone says it's going to make you money, or they want to sell it because someone says you are losing money. And then we also have the institutional investors. The two most important institutional investors on our market are the pension funds and the collective investment schemes, the mutual funds and the unit trust. Okay, so these guys have big amounts of money. Private pensions alone in Ghana is over 16 billion cedis, the tier 2 and tier 3 pension scheme. The total amount of money they are investing is 16 billion cedis. Now, if even 1% of that portfolio goes into the stock market, that is significant money. So that's a lot. And then you also have the collective investment schemes, the mutual funds, that also have bulk money that they can invest in the market. Okay. What are the key things to consider if you are thinking about the stock market? The first thing that you need to put in mind is that markets are not always efficient. It doesn't matter whether it's the US market, the Ghanaian market, or the Russian market. Markets are not always efficient. Now, there's a difference between price and value. Price is what you pay, value is what you get. Okay? Price is what you pay, value is what you get. Price and value do not always align. The fashion industry is a good place to know the distinction between price and value. Now, if you go and you buy ripped jeans are very expensive. Now, but if you go back 5 years, you couldn't sell a ripped jeans. There were no ripped jeans. If your jeans got ripped, you threw it away or you went to somewhere to patch it. Okay, but now people pay top dollar to buy ripped jeans. Now, so that is the price of the product. The value of the product is something completely different. Now, in the case of fashion, the value of the product becomes very subjective. Okay, so somebody like me, I will never wear ripped jeans because it has no value to me. But the young man will pay the top dollar to buy the ripped jeans. So to me, the price that I have been asked to pay for ripped jeans is not value to me. Okay, so price is what you have been asked to pay, value is what you get at the end of it. The same exists in the stock market. Price and value do not always align. There are times where stocks are underpriced. Like, you see, there are two main emotions that drive. So the second point, okay, we say the investors are driven by two extreme emotions, greed and fear. Now, it is these two extreme emotions that lead to underpricing of the market, underpricing and overpricing of the market. As we speak now, because of what has been happening in the banking sector, people don't want to hear about investment, and because of that, prices on the stock exchange are so much lower if you compare it to the value of the company. Okay, so we are living in a period of underpricing where you can buy something that is worth 10 cedis, you can pay 5 cedis for something that is worth 10 cedis because the stock is underpriced. Okay, but there are periods also where the stock market gets overpriced. So you have to understand that price and value don't always align, and there are periods where stock prices are lower than they are supposed to be, and there are periods when they are higher than they are supposed to be. Now, so Warren Buffett makes this statement. Warren Buffett, he's the He's the wealthiest investor in the world. He's the most successful investor in the world. Warren Buffett says, we are fearful when others are greedy, and we are greedy when others are fearful. What he means is that he goes into the market and he buys a lot of stocks in periods where prices are lower than they're supposed to be. Now, why is it that in every other thing that you buy, if you are going to buy jeans, and this jeans previously was sold for 100 cedis, and you go to the shop now and that same jeans is now on sale for 50 cedis, you're excited about it and you want to buy. However, when it comes to shares, when you see that the price are falling, that is the time that you want to run away from it. Why we the same people, why are we reacting in two different ways? One with physical commodities and the other with shares. If you understand the relationship between price and value, then you focus on value. If you know what the value of the asset is, when the price is way below the value, and that only happens when people are fearful, that is the time that you have to get greedy and buy a lot. So this year, I have been buying a lot of shares. I am not saying go out there and buy a lot of shares. I have been a stockbroker and in this industry for 70 years, so I understand what I'm doing. But all I'm saying is that there are times where prices are way lower than they are supposed to be, and that's the best time to buy. But he also says that we are fearful when others are greedy. In the times where prices are going up and everybody is buying shares and prices are all over the roof, that is not the time to go and buy shares. In fact, there's a funny adage that when you are going to visit your grandmother, okay, so you are on your way to visit your grandmother and you sit in a trotro, and then the trotro driver, you're sitting in front, and the trotro driver tells you that, oh, have you heard Standard Chartered shares are very good, you should go and buy Standard Chartered shares. And then you get to your grandmother's house, and your grandmother also tells you to go and buy Standard Chartered shares. If you have any shares in Standard Chartered, call your broker and sell it. Because when your trotro driver and your grandmother has heard it, it means the party is over. It means the prices are so high, there's so much noise about it that everybody has heard. At that point, the party is over. That is not the time to enter, that's the time to exit. Okay, the next thing that I want you to understand, especially in our market, is that you have to avoid speculation. Speculation is when you are buying the thing not based on its long-term value, but you are buying hoping that the price will go up in the short term and then you sell. Okay, so avoid speculation. The reason why you should avoid speculation is that our market is inefficient. We have quite an inefficient market. It does not work like how you'd expect it to be. Okay, and then also avoid excessive trading, where you buy today, sell tomorrow, buy today, sell tomorrow, because transaction costs in Ghana are very high. If you buy shares, you can pay as much as 2.5% of the value of the shares in transaction expenses. And if you sell the same 2.5%, so when you go in and out, you've lost 5%. You go in and out, you've lost 5%. If you are buying and selling many times in the year, and each time you go in and out, you are losing 5%. At the end of the period, all the possible or all the potential profits that you could have made would have gone to the broker in the form of transaction fees. Okay, so you should be wary about excessive trading. What you have to do is that you have to go in when the prices are low and buy with a long-term perspective. If for some reason you make big return in the short term and you want to take some of your profit, you take it as a bonus, but you don't go in with a mindset that you are going in speculatively to go in and out in the short term to make money. And investing in the stock market is only suitable for investors who have a long-term investment time horizon and people who have a high risk tolerance. I remember long ago when I was a stockbroker, young stockbroker, and Osofo came. I came to the office and I saw a purchase order. This Osofo wanted to buy Standard Chartered shares, Farm Milk shares, some good shares. But this was at the time where every grandmother had heard about the stock market. The stock market had gone way up, so it was at the peak, and I knew that it was going to fall. So when I saw that he had put in orders to buy Standard Chartered and Partnerz, the shares that they've been going up the whole time, I called him and I told him that these shares are long-term, like they are good if you are holding it for the long term. However, if you are not thinking long-term, this is not the time to buy it because they are overpriced. They are most likely to come down. He says, oh, I'm thinking long-term, buy it for me. So I bought it for him. And then 2 or 3 months down the line, as I predicted, the share price started falling. And this Osofo called me very desperate. This is long ago, 2004 or thereabout. He says, Willie, I have lost 10 million. And those days, 10 million was a lot of money. It wasn't today's 1,000 Ghana cedis. He says, I've lost 10 million. I said, Reverend, you haven't lost the money. You only lose it if you sell the shares. You said you're a long-term investor. As long as you're a long-term investor, it is going to recover and even make more return. And you're also going to receive dividends that you can reinvest at this lower price and make up some of the losses. He says, oh, who told you I'm a long-term investor? I've been watching the news and I saw the share price going up all the time. So I was hoping that the share price will go up and then I will get to sell it. If you are not a long-term investor and you don't have a high risk tolerance, meaning that if you buy shares, like let me give you an example. I started buying a lot of shares in July. So in July, I bought Partnerz shares at 2 cedis, 20% or something thereabout. And then by November or October, because of COVID, when their financial results came out, their financials were very bad and the share price dropped from the 2 cedis that I bought it for to 1 cedi, 8 pesos or something. Now, instead of panicking, what I did was that I bought double the number of shares that I bought when it was 2 cedis. I put in more money instead of panicking and rushing out, okay? Because I have the risk tolerance for it. I have a long-term perspective. I know Partnerz is trading way below what it's supposed to be trading for. So if it was good at 2 cedis and now it is 1 cedi, then it is even much better at 1 cedi. So instead of panicking and moving out, I'm going to buy even more. So I bought more than double what I bought when the price was 2 cedis to reduce my average unit cost per share and to make the money when the stock market eventually corrects. Okay. Now the returns that you make on the stock market reflects the expectation on the economy. I have a certain slide that I put in. I do some seminars, some training, financial independence clinic. I have one slide in there that I call political error analysis. And you would see that based on people's expectations on how the economy is going to go, dependent on which political party is in power, you see a reflection of it in the returns on the stock market. Last 4 years, well, the last 3 years, the trend has not followed. But the year after Nanado assumed office, the stock market returned 51%. Then the banking crisis happened, and then we've had negatives all through. All the gains have been wiped out. But anytime NPP is in power, people have this notion that for the NPP government to succeed, they only succeed by bringing down interest rates because of their philosophy of let the business sector be the driver of the economy. Okay, so they have to bring down interest rates so that businesses will succeed. Now, if businesses succeed, the stock market will do well. Now, when NDC comes to power, NDC is a social democrat. They increase the number of social interventions, which means that you are spending more. If you are spending more, it means you are borrowing more. If you are borrowing more, interest rate is going to go up. So now people move their portfolio from shares to fixed income because interest rate is going to go up. Okay, so people's expectation about the economy has an impact on the returns on the stock exchange. Good. So the current view, this here is showing you how ridiculously underpriced some of these companies are. Let me use just one, just for the sake of time, let me just use one to explain what I mean. Look at Cal Bank. Let me explain this figure, the price to book ratio. Now, this price to book ratio means that if today Cal Bank says that we are no longer going to operate as a bank. We are going to sell all our assets, pay off all the liabilities. Okay, the company sells all its assets, pay everybody it owes. The rest of the money will belong to their shareholders, their owners. Okay, now, if you compare the current share price to 1 cedi that each shareholder would get if the company ceases to exist, okay? So for every 1 cedi that a shareholder would get if Cal Bank ceases to exist today, the share price of that stock is 42 pesos. So basically what I mean is that you pay 42 pesos today, or assume that you have enough money to go and buy Cal Bank 100%. You buy Cal Bank 100%, you own the whole bank. The amount of money you would pay to buy Cal Bank 100%, for every 42 pesos you will pay for Cal Bank. If you decide not to run Cal Bank again, you sell Cal Bank, pay off all the liabilities. For every 42 pesos that you spent buying Cal Bank, you are going to get 1 cedi back. More than double your money. It is ridiculous. Companies don't trade that low. Now, these companies are trading this low only because share prices are so low following the cleanup in the banking sector. People are scared, etc., etc. The dividend yield, the money you get from dividends as a percentage of what you paid for it is 13%. You know, so ridiculously low. Let's forget about PE ratio. But the picture I want to show to you is that all these companies, Cal Bank, Enterprise, EcoBank Ghana, Ghana Commercial Bank, Stanchart, Enterprise Group, Total Petroleum, are trading at ridiculously low prices that we have not seen in my 17 years of being in this market. We have never seen valuations this low before. Never. When I joined the business in 2003, we said equities were low, prices were low. But if I look at today's valuations and I compare to 2003, it is not comparable at all. Ridiculously low valuations. Okay, so if you ever are thinking about investing in shares, this is the time, as long as you are a long-term investor and your risk tolerance is high. Okay, so concluding thoughts. The last decade, a little more than a decade, or if we go all the way back to 2009, so yes, so the last decade has not been good for shares at all because the economy has not been favorable for business. We've been here, we all know what has been happening. Business confidence has been very low. The economy has not favored businesses. Recent events following the banking crisis has been terrible for business. Before the banking crisis, we had the cedi depreciating massively, and then we had interest rates very high during the Mahama administration, not ideal for business. So we have not had a favorable environment for businesses, and because of that, equities have not done very well. Now, following that history and then the recent panic in the banking sector, prices of equities are lower than they have ever been in the last 2 decades. If you look at the last 20 years, we've never seen prices as lower than this. Now, the risk is that there is no one here who can tell you certainly that what we are experiencing, the turbulence in the economy, is over and things are going to do very well in the economy. You cannot tell certainly. However, things are so low, prices are so low that I don't see how much lower I can go. It's like we've hit the bottom. So if you would ever consider investing in equities, this is the time for you to get in. Thank you very much. So Alex, I don't know whether we should take questions for this one before we do the retirement planning, or we should do everything and then take questions. you would give direction on how.
So, can you hear me?
Yes, I can hear you.
Right. So thank you so much for the presentation. Wonderful thoughts being shared. I want us to briefly break it down to the knowledge of some of the people who are listening to us. I'm very sure that some people want to know some basic procedures, basic decisions to make, why they should even make it in the first place. So before I even start taking the questions, the first.
Hello, Alex. Alex.
Hello, can you hear me?
Yeah, I can hear you now.
Okay, so I was saying that I'm very sure that some people want very basic know-how market. What are the betting out? What are the potentials, right? Like in the market.
So we don't have a lot of research in Ghana, but for the developed markets that have done research over long periods of time, remember we said those that in the long term, returns in the stock market outstrips returns any other form of return. In the developed markets where research has been done. For a long time, there was a debate in the developed market as to whether investing in real estate long term was better than investing in the stock market. However, that debate. However, I mean, over the last 10 years, returns in the stock market has not been good at all. Okay, so if you are using the last 10 years as your measure of long term, then this idea of the stock market being a good place for long-term investments will not be valid. But if you take I mean, personally, most of the money that I started in 2003 for the period where the stock market was very good, from 2010 all the way to, from 2000 to 2008, the stock market did extremely well. And then I came in 2003. So I joined the market in that period. Okay, so if you are thinking long term, if the economy gets back on track, that is where the real money is. Because you see, what do we mean by an economy doing well? An economy doing well simply means that businesses in the country is doing well. Like businesses in the country is doing well, then the people who do well are the people who own the businesses. And if you can't start your own business, then the way to get into that game is to buy part ownership of businesses. And that is through the stock exchange. Okay.
Right.
So that is what it means. But there's the caveat there is whether our economy will get back on track and do well. Okay. Because that is the factor that will determine whether you do well investing in stocks or not. But what I'll say is that because the people that I'm talking to, I think the average age of the people on this webinar will be less than 30, right?
Yeah.
Now, if the average age is less than 30, so all of you are younger, you have a long-term investment time horizon. If your risk tolerance is high, I would encourage you that you put a little bit of your portfolio in stocks, because you see, prices are so low that when the market corrects, it's not going to correct by going up 20%, 30%. It's going to correct by going up 200%, 300%. That's the kind of crazy returns that you can see in the stock market.
And we saw that in 2017.
Yes, it can go crazy. It can go crazy. Okay, we've had a year, 2003, the stock market went up 150 something percent in 1 year. Some particular equities like Guinness in that year went up over 300%. Okay, so when things are so low now and you are a young person, I would encourage you, as long as you have the risk tolerance, you start with 10%, put 10% of your total portfolio in equities and give yourself 3 to 5 years, and you'll be amazed what that portfolio will do for you.
Okay, William, thank you so much. I also want to add that over the period, as we can only connect the dots when we look back. Although that can be the best investment advice that we can actually give to anyone anyway. But what we know is that over the past 30 years, since the stock market has been in existence, it has gone up to over 4,372%, which is an average all share index rate, which is actually good. Which means that if you put 1 cedi in the stock market all share index at the start of the whole game, it will be 41 cedis as of now, and which is actually a very huge growth potential. And I feel like when Corona and all these things are over, we are going to see a very huge growth, especially in the stock market. And so thank you for this. My next question that I also want to ask is that I also want to add basically is in the financial planning process, right? When you're planning for your finances and all your retirement, and then your estate planning, and then also leaving a legacy behind your back. Why do you need to purchase stocks? Because basically, I believe that it's one of the ways that rich people pass on generational wealth when they are gone. Can you throw more light on that? Okay,
so companies, or strong companies, successful companies, outlive their founders, they outlive generations. As the years go by, they become even more and more valuable. Now, so if you are thinking about generational wealth, what better way to create generational wealth than to own a part of successful companies? Okay, because you'll be dead, your children will be dead and gone, and the successful companies today, some of them will be even more successful than. They'll be bigger, they will be so much more valuable. Now, so if you're thinking long-term and you're thinking generational, what better way to achieve it than to own a part of these successful companies, so that as the wealth of the companies grow, your wealth grows with it. I mean, the developed markets that have been in existence for 200 years and things, when you hear some of the stories, like you take Warren Buffett. Warren Buffett started a partnership in the 1960s. It is reported that every, I think it's 10,000, every 10,000 cedis, if you had given Warren Buffett 10,000 cedis then, and you had left that 10,000 cedis with him all the way up to this time, that 10,000 cedis would be worth some billions of dollars. Sorry, $10,000. Okay. That is the US economy. The US economy has grown leaps and bounds compared to the Ghanaian economy. But what it means is that as countries prosper, and Ghana is prospering. I mean, those people who have left Ghana for 20 years, when they come back and they still have the image of the Ghana that they left behind, when they come and they see the current Ghana, they get surprised. So we are prospering. We can do better than we are doing. But as the economies grow, as countries develop, what develops the countries are the businesses underlying the business, underlying the country. So the way to preserve wealth and to generate generational wealth is to be a part owner of these great companies that are going to represent the wealth of the country in the future.
All right, William, thank you so much. So the next question that I would want to ask, so now let us say I've decided that, okay, fine, I want to invest money in the stock market. I've listened to William. I think I have an expose on what next. What should I? What are the steps that I should take to be able to make a successful run? Yeah.
Okay. Now, so the first thing that you have to bear in mind is that you cannot invest on the stock market on your own. You need a broker. Only brokers can buy and sell shares on the market. So the first thing you have to do is to find a stockbroker. Now, if you're going to find a stockbroker, the kind of things that you look out for is that how responsive is the shareholder, especially to you, the small investor. I have a friend, my stockbroker, I send them an email that a friend of mine in the US wants to start investing in Ghana, and so they should send her forms. They didn't bother to send her forms because, you see, they have positioned themselves to say, we don't want to deal with retail. We don't have time for the retail investor. Our clients are only pension funds, mutual funds, foreign investors. Those are the only ones we want to deal with. So you have to find a broker that is suitable for you. Apart from this, my friend's brokerage firm, a lot of the other brokerage firms, when you go there, they would say that, yeah, you can open an account. So even though they will not turn you down, they still will not get time for you because you are not part of their target market. Okay, so you have to find an appropriate broker who would have time for you, who will consider your business as necessary to them. Okay, and usually they are the small brokers. The big brokers usually don't have time for the small retail investor. Okay, so if you go to the Securities and Exchange website, you will see a list of the stockbrokers there. But what you have to do is to shop around, visit a few of them. SAS is, so they are good brokerage firm to deal with, but visit a number of them. What are their charges? Because the brokerage fees are not fixed. Okay, the brokerage fees are not fixed. Now, usually when you're a small investor, your bargaining power is small, so you cannot bargain your fees. So you have to find out some of the brokerage houses, they have fixed their fee cost is 5%. So when you are standard, there are others who are charging 2.5 for the small retail investor and will only negotiate down when they are dealing with the big guys. So you have to bear that in mind also. And then the next, okay, do they do research? Because you have to be able to benefit from free research. Some of the companies should be able to put you in a mailing list to do research into the various companies listed and give you an idea of where to invest, which one to buy, which one to sell, even before it happens, because they are doing research and talking to the companies and having an outlook of that business. So how good is their research? That is also another thing that you can look out for. So these three main things. Will they have time for you? Okay. What is their fee structure like? And will you get research? These are the three things that I think you have to look out for. But the full list of brokerage houses, if you go on the Securities and Exchange Commission website, you will find the list of all the stockbrokers there.
Okay. The very last personalized question would be, so let's say I work and I earn 2,000 cedis a month.
Yes.
And now I've listened to William, so I want to make a decision on investing. Which portion of my money do you think should go into purchasing stocks on the market?
Okay. So there is no answer to that, because like I said, it depends on the person's risk tolerance. So so let's say that you are putting aside 20% of your 2,000 every month. So every month you are investing 400 CDs. Now if you are investing 400 CDs a month, how do you apportion that 400 CDs between fixed income, between equities, and maybe between some mutual fund or something? There is no answer to that question. It will depend on the risk tolerance of the individual. But what I want to encourage people who have not started investing in stocks at all on this platform is that try with 10% of your entire portfolio. Okay, so I'm not saying every month go and invest 40 CDs, because you can't invest 40 CDs a month. Okay, but if your entire portfolio, you put aside 400 CDs every month. Okay, so in a year, you are putting aside 4,800. Okay, so of the 4,800, so let's say 1 month of the 12 months, that 400 CDs committed to shares. That's what I'll say for those who are starting, and just use it to test the market and see.
Okay.